And now let us go ahead and take a look at some dynamite positions that will get us P.A.I.D. We're talking about that USO, that OIL, and that UGA. And we've been getting paid P.A.I.D. consistently on those positions as we have seen the price of oil move to the upside. But there are some things we should not get complacent. No. We can't get complacent because there are some things that command our attention as it relates to the overall oil industry. We're talking about both domestic and international. Now, as a result of that, we must understand and understand exactly how to position ourselves to get P.A.I.D. from what's happening with regards to the global markets. Now, as you know, oil is indeed a commodity, and as a result of it being a commodity, it can be, speculated upon, it can be manipulated very, very easily. So we must see now what others see eventually. And we must make sure that we have adequately positioned ourselves to get P.A.I.D. no matter whether or not the manipulation comes from domestic activities or international activities. So I need for you to please pay close attention and take copious notes upon the information that you are about to receive pertaining to what's really going on in the oil industry. Okay? Now, the 2018 oil rally is happening at breakneck speed. We're talking about breakneck speed. Real fast, okay? And West Texas Intermediate, talking about that WTI, okay, last week hovered above $66 a barrel, while Brent crude was reaching, believe it or not, $71 a barrel for the first time since December of 2014. That means as of last Wednesday, okay, we're talking about a week ago, WTI had risen 12.2% for the month, and Brent had risen 8.1%. All right? Now, I've spoken to you in the past about the narrowing of the global crude oil balance for some time, but it's looking more and more like the balance is arriving quicker than anticipated. So, as a result of that, we must go ahead and drill down on this particular occurrence. Now, this is what it'll mean for oil prices. The single most important factor for oil prices is supply and demand. The amount of surplus volume in the market will indeed stabilize, and that's a fact. But unlike what some of the pundits on Bloomberg and CNBC may say, the point isn't to eliminate the surplus. Excess available supply provides a necessary buffer that restrains on large swings in oil pricing. Now, it's when traders have concluded that the supply is increasing due to overproduction, that is what puts downward pressure on prices. Now, if that overproduction is further fueled by operators desperate to keep the doors open, the pricing pressure becomes even more acute. The last month has indicated that we are now out of that period. Wellhead prices, the first arm's length transaction, the oil exchange at which the producers make their money, that's called the wellhead prices. They are now in the range of the low 50s. And at this point, most U.S. producers can run a profit in feeding excess volume into the market, to avoid the sheriff becomes less of a concern. That is to say, they can turn around and not be so much concerned about running and pushing profit margins because of the way they've got the supply and demand cycle currently indexed. Now, any oil trader will tell you that predictability is one of the most important single factors in stabilizing transactions. Now, of course, there will still be fluctuations in either directions, to the upside on pricing or to the downside on pricing. But the range, family members, the arbitrage will be less. Now, the OPEC-Russian agreement on restraining production is holding, with some cartel members even extending the cuts beyond the levels agreed upon. Now, continuing production problems in member nations such as Venezuela and Libya and Nigeria have improved the decline perspective. There are just 3 wild cards, though. 3 salient points that we have to factor in moving forward. Please listen to me intently. First, U.S. production. You see, the impact of U.S. production has always been a wild card when it comes to the price of oil. American volume has never been a part of the OPEC's accord. With U.S. exports increasing to the global market, how much is produced in the United States has a much more direct influence on the prices. And His Royal Highness Donald Trump, what did he mention in his first State of the Union address? He mentioned that he wanted the United States to be the #1 oil exporter on the planet. For years now, crude oil prices have been determined globally, especially in developing regions, not in North America or Western Europe. Now, until Congress allowed the exports after a 4-decade prohibition, the United States influenced the market primarily in the level of daily imports that the country required. Now, U.S. producers can export to outside markets having higher than average prices, improving profit margins and relieving somewhat the domestic pricing pressure from having the produced supply remaining in the local market and depressing WTI levels. Therefore, in the current climate, traders have concluded that the level of U.S. production does not have the same impact it had 6 months ago. Now, at home, companies can balance production since sale revenue is indeed much higher. Now, abroad, the problems in several main producing countries, combined with the OPEC cuts, provide greater flexibility to absorb American exports. But that's not the only thing improving the floor for oil prices. No. The second thing, the second wild card, the second salient point that we got to keep our eye on is the U.S. dollar. You see, we have to factor it in, okay? Because the exchange value of the U.S. dollar is currently, at least, buttressing the price of crude. Now, the vast majority of daily oil sales worldwide are denominated in dollars, okay? AKA the petrodollars, put into place by old Tricky Dick Nixon, Richard Milhouse Nixon, when he was president. Now, when the value of the dollar rises, listen now, when the value of the dollar rises, okay, vis-a-vis other major currencies like the euro, the pound sterling, and the yuan, it costs more in local currencies and the oil price declines. Let me repeat that now. When the value of the dollar rises, okay, vis-a-vis other major currencies like the euro, the pound sterling, and the yuan, it costs more in local currencies and the oil price declines. However, the converse tends to be the case when the dollar weakens. And family members and listeners are like, that is the case now. You see, the softness in the greenback has been providing support for rising oil prices. This relationship seems less direct than had been in the case in the recent past, but it's still a factor. That's good if you're selling oil abroad, but it's not so good if you're importing French wine. The third thing that we got to keep our eye on, okay, is short contracts. Short contracts. Now, let me explain that. You see, oil price rises and has also been supported by the unraveling of short contracts. You see, shorts are run when a trader believes prices are going to go down. They're going to decline. Now, some shorts are even drawn in the hope of being self-fulfilling contracts. Okay? After all, if a person appeared on TV saying the sky is falling and others believe it, oil prices, okay, and other things won't be as relevant, but people will start running for safe havens, right? And whoever's in the safe haven business, all right, their prices will rise. However, if somebody, let's take out the safe havens, okay, in that facetious example that I just gave you, and let's do this. Let's say some major pundit on one of the economic channels, Bloomberg, CNBC, or whatever, gets on there and says that the price of oil is going to fall, and they start shorting the price of oil massively, guess what will happen? The price of oil will indeed fall, irrespective of the supply and demand cycle. And usually when they do that, the persons have already taken large, huge put options on the price of oil, or shorted the price of oil through future contracts. And as the price of oil falls, those puts and those future contracts that have shorted that particular commodity oil rise. Nothing but gain. Okay? Now, running shorts when the price is rising is a certain formula for losing a lot of money. Okay? You don't want to do that. You do that when the market, and you feel the market, is going to move down. That's when you short the position. And that's because the shorts, okay, must be covered when due if the price of the commodity, in this instance oil, rises. That means the short holder must move back into the market and buy the contracts covered by the short that he or she took. Now, if the underlying price at redemption is higher than the price paid when the short was introduced, it costs the short person, the person who took the short, more than the short's initial face value. Now, taking options on the short changes some of the dynamics, but not the overall results. You see, in the resulting squeeze, shorts will be liquidated early, resulting in a spike in the underlying crude oil prices. But the dollar exchange rate and the volume of the short positions may indeed change. Now, at the moment, as I speak, both are contributing to a rise in oil prices and will continue to drive prices even higher. Fact is, oil's continued climb over the past few weeks has indeed been incredible. All right? Even so, at the end of the day, we need to continue to get P.A.I.D from our OIL, USO, and UGA position, which is the associative gasoline position. But we need to be cognizant of the fact that we can pull the trigger at any time, and we're going to keep our trailing stops tucked up under us to protect the lion's share of our profits. You see, at the end of the day, we have to understand and understand that commodities, i.e. oil, gold, and pork belly, soybean, and the like, they are some of the most heavily manipulated and speculated types of investments out there. So you need to understand and understand that you must monitor the politics that go on with regards to the pricing of commodities. Oil is one that is paying us handsomely now, but we will know that in the event that there's some overt manipulation, we know exactly how to run for the gates before the herd and get P.A.I.D, maximizing our profits and minimizing our downside. When we come